Hi all, this is CM Agustri. In today's video, I will cover IND AS 113 fair value measurement. Before directly jumping into the standard, let us understand what is the objective of the standard. The standard provides guidance and a framework for valuing the asset or a liability as on the balance sheet date, that is measurement date. Okay, if the respective standard specifies how to value the asset or a liability as on the balance sheet date, we should follow the standard. If the standard doesn't give the guidance, we should follow this standard, but determining the value of the asset or a liability or equity as on the balance sheet date. Now let us understand fair value. What do you mean by fair value? Fair value is nothing but a price, that is nothing but an exit price that could be received to sell an asset or a paid to transfer a liability in ordinary transactions between market participant measurement date. Nothing but we are trying to find the value of asset or a liability as on the balance sheet date, because balance sheet, as you know, balance sheet date, balance sheet, what the balance sheet says, balance sheet is a position of the company as on date. It's not, so we should try to figure out, we should value the asset or a liability as on the balance sheet date, and we should, then only it will give the true and fair view of the company as on the balance sheet date. Okay, what are the major terms here used are price, appropriate market, market participant, ordinary transaction, measurement date. We will learn about this, all this in detail further. Okay, now, what do you mean by asset specific restrictions are considered, entity specific restrictions are not considered? Means what it exactly means. Suppose the entity has a land. As per the object clause mentioned in MOA, entity can use that land only for commercial purpose. It cannot use that land for residential purpose. Right? However, the buyer can use that land for commercial as well as residential purpose. Okay. This is mentioned as per object clause, entity cannot use the asset for the residential purpose. It is an entity specific restriction. But however, the land can be used commercial as well as residential purpose. While determining the value of a land as a balance sheet or some other X measurement date, we should take all the possible ways that which the land can be used, and we should figure out highest and best possible use, and we should value the asset based on the highest and best possible use. Okay, I think you are clear. Example, what do you mean by asset specific restriction? That land can be used any purpose. Either the buyer can construct buildings for building and give on rental basis. It can run, if he can run a restaurant and it can use for commercial purpose. And so based on the usage of the land, the value of the land differs, right? However, as per the laws and regulations, no one can open a pub or a bar in that locality. So however, the value of the land will be more if it is used for the construction, if it is used for running the pub. But we cannot use that land for use that land as per laws and regulations in that locality. This is asset specific restrictions. Asset specific restrictions are considered while determining the value of the land. Entity specific restrictions are not considered. This standard is drafted from the buyer's perspective. What what is the maximum price the buyer will be willing to pay for purchasing the land or some X asset for a liable transfers for transferring the X liability? That is what we are considering in this stand. That is how this standard was drafted. It is also like logical. What is the price the buyer is willing to pay? Certain but the value of the asset, right? That's what. So while calculating that value, we should consider what are the possible ways in which that asset can be used, and we should derive the highest and best possible use, and then we should derive the value of such asset. Next, next. Now let us understand one by one. What do you mean by market participants? Basically, tell me one thing. What are the basic things for sell? What are the major, if you want to sell, what are the main important points? There is a market, there should be a market, there should be a buyer, right? Market, buyer, and price. These are the three things. We will learn about this. Market is nothing but appropriate market, and buyer is nothing but market participant. Price is nothing but transaction price. Price is nothing but a price at which entity asset can be sold. Now let us understand what do you mean by market part. Who is known as market participant? Instead says market participant is a market party nothing but a buyer. It should not be related party. If asset can be sold to related party. If it is sold to related party, if he is a related party, it should be arm's length price, and the transaction should not be under force. Like he should uh, forcible way. You should not purchase that, and the buyer should have all the available information, right? So, while determining the value, we should take into account like market participant is a person who is not a related party. If he is a related party, should be at arm's length price, and uh, he should be aware of all the information. If he is aware of all the information, what is the price he is willing to pay, and he should not be purchased under forcible way. You should stress-free manner. You should enter into the transaction, right? That is that is what here institute defines a market participant as. Market. Standard classifies the market into two: principal market and most advantageous market. What do you mean by principal market? Principal market is a market where large volume of transactions happen. Most advantageous market is a market where net proceeds are higher. Institute says if the asset can be sold or a liability can be transferred in both principal market and most advantageous market, give preference to the principal market for determining the value of asset. Why? What is the logic behind? You may say most advantageous market is a market where net proceeds are high. We should consider most advantageous market, right? No, not like that. Logically, it should be most advantageous. Basically, it should be most advantageous market. We should give preference to most advantageous market. We will figure out at which market we will get higher net proceeds, and we'll consider the value of asset from that. But not that is not the way we should consider. Instead, says if there is a principal market, give preference to the principal market and then go to the most advantage. If there is no principal market, then only take the most advantageous market. What is the logic behind this? What I just said, principal market is a market where large number of transactions will happen. Means the chances of liquidating the asset is higher in the principal market, and the price which is more number of market participants are participating. The price which is quoted in the principal market is more faithful and more reliable. So if you take that value for determine the value of asset or a liability as of the balance sheet date, it will be most appropriate, most reliable, relevant for the users to rely on that statement, financial statement. That is the logic behind. Example, I can take example. See, a diamond dealer can only export 10% of his production to the exports. Remaining 90% should be sold in the Indian market. So the principal market is Indian market. However, export the value of the price in the export market will be high. He can sell at more price in export market. However, it shouldn't take for determining the value of asset. We should take only market price quoted in the Indian market. It is a more reliable. 90% of the his sales will happen in India. So the chance of liquidating the asset is more in India. The price quoted in India is more faithful, more reliable, and chance of liquidating asset in India market is high. So while determining the fair value of asset or a liability, or for calculating the fair value of asset or a liability as on the balance sheet date, we should take the price quoted in the principal market. If entity doesn't have the principal market, then only you should go for most advantageous market. Most advantageous market is a market where net proceeds are higher. Okay. Um, so one more example I can say. If you take, if an entity invested in shares of X company, the shares of that company were listed in both BSE and NSE. So BSE is BSE is a market where large number of transactions happen. So we have prices from the B. However, the price quoted in NSE is the high. So most advantageous market is NSE. Principal market is BSE. For determining the value of the shares of value of the investment the entity made in X company, you should take the price quoted in the principal market, not the price quoted in the most advantageous market. I think you are clear. the logic behind the why we are taking the principal market, even if there is a most advantage market, because principal market is a market where the large number of transactions will happen, and it is a most liquidating. So the possibility of liquidating the asset in the principal market is easier. So that is the reason why we should consider the principal market. Key aspects. Now, let us understand. So we are good at market part. What do you mean by market participants? We are able to now, and we are also able to know about market. Now let us understand price. What do you mean by price? What do you mean by price? So price is nothing but a fair value is a fair value is the price that could be received from the sell an asset or a pay to transfer a liability in ordinary transaction in the principal or a most advantageous market at measurement date under the current market condition in exit price, regardless whether price directly observable or estimated using other valuation techniques. So price is nothing but exit price. That price that what value or at what price the entity can sell the asset or transfer a liability. Okay, we should while determining the fair value, we should less available price, that is quoted price, minus transportation cost. That is, we should not deduct transaction cost. What is the logic behind why we shouldn't deduct transaction cost? We are valuing the asset, right? We are valuing what in now let us understand what is transportation cost. Transportation is the cost which is incurred in order to sell the asset. uh, at transaction cost is nothing but, what are the examples of transaction cost? STT, brokerage commission, etc. These are the specific cost incurred for specific transaction. Okay, this is not the cost related to asset, right? So we should not consider the transaction cost while determining the fair value of the asset. I think you are correct. While determining the fair value of asset, shouldn't take the transaction cost. If you take the transaction cost, it is considered as fair value minus cost to sell, right? Why we shouldn't take transaction cost? Because what is the example of transaction cost? Transaction cost is nothing but STT, brokerage or commission. This is the cost related to a particular transaction, not related to the asset, right? So we are determining the value of the asset. While determining the value of asset, we should not consider the transaction cost. Why we need to consider transportation cost? Transportation cost is what is the logic the institute the standard says. Transportation cost is necessary for selling the asset, right? It changes the location and condition of the asset. Suppose if there is a commodity, in order to sell that commodity, you have to take that commodity to the particular location. So it's changing the condition location of the asset. So it is a cost related to the asset. So that is why we should consider, while determining the fair value, we deduct the available price minus transportation cost. However, we should not deduct transaction cost. However, in order to calculate the most advantageous market, suppose if asset can be sold in A market and B market, we want to determine, we have to calculate the where we can receive net proceeds, higher net proceeds. In order to determine the net proceeds, where we can receive the net proceeds, more net proceeds, we should consider all the costs, and we will calculate net profit rates. For determining the most advantageous market, we should take transportation cost and transaction cost. However, we'll determine the fair value, we didn't take transaction cost. I think you are clear. So for determining in crisp and clear manner, for determining the transaction cost, so for determining the fair value, we shouldn't take transaction cost. However, for determining which market is the most advantageous market, we should consider transaction cost and transportation cost, and then we should calculate the net proceeds, and then we have to decide which market is the most advantageous market, and considering we'll take the most advantageous market and price of quoted in the most advantageous market, and then based on that price, we will calculate the value of asset or liability as on the balance sheet date. I think you are clear. Now let us solve one question so that you will be understand more in detailed manner. See, this is example. what this question says, uh, entity as an asset, as entity can sell this asset in two different active market at different prices. Okay, an entity enters into a transaction in both the market and can assess the price in those markets for the asset at measurement date. The price that will be received is, if an entity, there are two markets. Entity has an asset, it can sold the asset in market A and market B. If the entity wanted to, if the entity can sell the asset in the market A, the price is 26 and transaction cost is 3 and transportation cost is 2. If the entity sells the asset in market B, the price is 25, transaction cost is 1, and transportation cost is 2. What it asks us to calculate? The fair value. We have to calculate what the fair value of asset if the market A is the principal market. Okay, if market A is the principal market, okay, if what is asking us to calculate the price of an asset if market A is a principal market. It has given us that A is a market, A is a principal market. So what the institute says, if the entity, if we have principal market and most advantageous market, we should calculate the value of an asset based on the price quoted in the principal market, right? So what is the price quoted in the principal market? 26. How we will get fair value? Price quoted in the principal market minus transportation cost. Okay, since transportation cost we should deduct for determining for calculating the fair value, transaction cost we should not consider. Why? Because why we shouldn't consider transaction cost? The transaction cost is cost incurred for because of some particular transaction, that is not cost of the asset, right? So that is the reason why we should not consider the transaction cost. Again, I'm repeating, if we have principal market, we should take principal market only, not the most advantageous market. Why? Principal market is a market where large number of transactions happen, so the chance of liquidity of asset is high. It is more reliable if we take the price quoted in the principal market. So we will take the price quoted in the principal market. Second thing, we should not deduct the transaction cost while determining the fair value of asset. Why we should deduct the transaction cost while determining the fair value of asset? Because transaction cost is a cost which is incurred for a particular transaction, not it is a cost related to the asset. And why we need to include the why we need to deduct transportation cost while determining the fair value of asset? Because transportation cost changes the location and condition of asset, right? For selling the asset, we have to transport the asset to that particular location. It changes the location and condition of asset, that is belonging to the asset. Cost incurred, cost related to the asset. So that cost is we are deducting that cost by determining the value of asset as on the balance sheet date or some X measurement date. I think it is clear. Now let us understand second part. So now let's quickly jump into the answer for first question. So what if market A is a principal market? The market is a great volume of large activity of an asset. The fair value of asset will be measured using the price that is received in that market after taking the account of transportation cost. Price available, price receivable is 26, transportation cost is 2, fair value of asset is 26. I think you are clear. Now let us understand fair value of asset if none of the market is a principal market. So if both the market is not, if none of the market is the principal market, we should out of these two markets, entity can be sold in two markets. We should first we should identify what is the most advantageous market first. So how we will, and for identifying the most advantageous market is nothing but what the name itself says, where you can receive the net more highest more net proceeds is nothing but the most advantageous market. In such a situation, we should calculate uh, so we should for calculating the most advantageous market, we should find out we should calculate the net proceeds from each of the market, and we should take highest we should which market provides us highest net proceeds, that is known as most advantageous market. So 26 minus 3 minus 2, what 26 minus 3 23 minus 2 21, 25 minus 3 22. The most advantageous market is 20 market B, because market B net proceeds are higher, right? So however, for calculating the fair value, we should not deduct transaction cost. So 25 minus 223 is the fair value. Now let's quickly jump into the answer. So if neither of the market If neither of the market is a principal market of asset, the fair value of asset will be measured using the price in the most advantageous market. The most advantageous market is the market the maximum is the most amount that could be received to sell an asset after taking into account of transaction and transportation cost. The net amount will be received in the respective market. So price receivable in market A minus market B. So since the entity will maximize the net amount that could be received from the asset is market B 22, the fair value of asset will be measured using the price quoted in the market B. The fair value is nothing but price quoted in the market B minus transportation cost, that is 23, right? I think now it's clear. Let's quickly revise what we have read till now. So we have learned the definition of fair value. Fair value is nothing but is a price the entity could sell an asset or a transfer a liability as on the measurement date, that is a balance sheet date, to the ex party, that is a buyer. In simple terms, I'm saying. So for selling asset, there are three major requirements. Uh, Market we need, price, and buyer, right? Buyer is nothing but a market participant. Price is nothing but at what price that we can sell the asset, and market we are classified into principal market and most appropriate most advantageous market. So if there is a two market, we should consider price quoted in the principal market, not the most advantageous market. For determine the fair value, we should only consider transaction cost. We should not deduct transaction cost. However, we should deduct the price quoted minus transportation cost equal to fair value. So now, for however, for fat, we are for we are good at till now, right? Now let us jump into quickly non-financial asset, violation of non-financial asset. So what do you mean by non-financial assets? So non-financial assets like land, building, biological asset, etc., which has many possible uses, right? For determining the value of such asset, we should consider highest and best possible use and then determine the value of asset. Example, if an entity has a mill, entity has a land. Currently, it using that land for as a windmill, right? Entity want to sell that land to the buyer. If entity sells that land to the buyer, that is market participant, it can be used for commercial, residential purpose. It can all the entity, the buyer, market participant can construct a big hotel, restaurant, or some pub over there and generate huge revenue. Based on that, the value of land will increase, right? So currently the entity using that land for running the mill, so that the value of land is currently is 100 crores. If that land is used for the purpose of, if it like a big Taj if market participant is a big Taj hotel is constructed in that land, the value of the land definitely will increases. The value of the land is 150. However, while while determining the value of a land, we should determine the value of a land based on the highest best possible use. Okay, not only the current use. So highest in 150 crores. However, first in order to construct that restaurant or a hotel in that land over that land, first the currently the which is the windmill has to be demolished, right? So we should also consider that cost. So the cost for demolishing the windmill is 30 crores. So the now for doing valuation of the land, we should consider 150 crores minus 30 crores, that is 120 crores. So highest and best possible use is one. If you consider highest and best possible use, the value of the land is 120 crores. So, in short and crisp manner, if highest and best possible use, we are there are many use, exhaustive use. There are many use. Instead, not saying consider all the uses and consider highest and best possible use. No, you consider highest and best possible use in that locality. If it is any it can be if the asset can be used in a better manner by the buyer, consider that use and then determine the value of asset and then recognize in the books of accounts. Not is the current use, nothing but the highest and possible. If it is not possible to determine the highest and best possible, consider the current use as the highest and best possible use and determine the value of asset on the balance sheet date, nothing but measurement date. Okay, valuation techniques. Okay, uh, if there is no such quoted price available, you should do the value of asset, right? So example, if you have a gold, you have 24 karat gold. For valuation technique, for valuing the asset or a liability, or as on the balance sheet date or equity, entity says maximize the observable inputs and minimize the unobservable inputs. What do you mean observable inputs means? Like readily quoted price. If you have equity shares, listed equity shares, the price is readily available in the stock market. It is observable input. If you have 24 karat gold, the price is available readily in the market price, right? So it is observable inputs. So while valuing the asset or a liability, if you have an observable input, use it and determine the value of asset. If it doesn't have that thing, uh, then unobserved inputs, like you determine how much cash flows that can be generated from using the asset, how much we need to cost is going will, and we discount them using the relevant rate, risk-free rate, and determine the value of asset. There are many approaches like got discounted cash flow method, Gordon's formula, using that valuation techniques and determine the value of asset. If nothing is there, so what the standard says, if there is observable, if there are observable inputs, use it. If there is no observable inputs, then go for unobserved inputs. What the objective of using the valuation technique is estimate the price. Quoted prices are not available in the principal or most advantaged market at which ordinary transaction will be takes between market participant and measurement under current market conditions. An entity shall use valuation techniques that are appropriate to circumstances and with sufficient data are available to measure the fair value, maximizing the use of relevant observable inputs and minimizing the use of unobservable inputs. Inputs to valuation techniques. Observable inputs based on the market data obtained from the independent sources like share prices in BSE, gold rate in the commodity, etc. Unobservable based on equity own assumptions about financial factors, example, projected future cash flows, etc. We will project the cash flows and determine the value of asset. Like, what are the valuation of techniques? Uh, why this hierarchy is given? In order to maintain consistency and so that clarity will be there. If first level one inputs, if quoted price is available for identical product, right? So if there is a similar identical product is there, the quoted price is there. Like if you take 24 karat gold, if you take 24 karat, if you have 24 karat gold, the identical price quoted price available uh, for 24 karat gold, we will have a 24 karat gold price in the market, right? We will take that price and determine the value of asset. If identical price for identical asset there is no quoted price, then we'll go for level 2 inputs. We will take similar asset and what is the quoted price for similar asset and make some adjustment and determine the value of this asset. Example, if we have 23 karat gold, we in the market we have quoted price of 22 karat gold and 24 karat gold. So in order to determine the quoted price of the 23 karat what the value of 23 karat gold, we should make some adjustment for 22 or 24 karat gold and determine the value of the 23 karat gold side. That is what. If the quoted price available for identical asset, take it. If the quoted price not there for identical asset, you take the quoted price of similar asset, make some adjustment and determine the value of asset. Level 3 inputs. Level 3 inputs like unobserved inputs of the asset, like it doesn't have any quoted prices. Then we should estimate how much we should estimate the how much cash, what are the cash flows the asset can generate from usage of the asset. Discounted cash flows using the appropriate discounting rate and determine the value of asset. So we have various valuation techniques like valuation methods like market approach, income approach. We have various valuation techniques like market approach, income approach, cost approach. What do you mean market approach? Market approach is nothing but PE ratio. We will anyways we have earning per share of our entity, and we'll take a PE ratio of identical entity or similar entity, and we'll calculate take that PE ratio. Okay, PE ratio nothing but market price by EPS. So then we will get PE ratio. So for identical entity or similar entity, shares are quoted in the market. We will take what is the market price of the shares of the similar entity and what is the EPS of that entity, and then we'll get PE ratio. What is the EPS of our entity? EPS of our entity and PE ratio which for a similar entity we will get the market price of the our share. In this market price of the shares which is invested in our market price of investment. So in that is a one way of calculating the value of asset in the balance sheet. Income approach. What is meant by income approach? Income approach is nothing but we will calculate how much cash flows that we can generate from that asset. We discount that cash flows using appropriate discount rate, that is like Gordon's formula, etc. And cost or asset approach is nothing but what is the cost we are going to take. So for asset we should while valuing the asset or a liability as on the balance sheet, we should consistently use the same valuation techniques, right? If we want to change the valuation techniques further in order to make it's more reliable and faithful represent more reliable in order to meet the reliabilities, then it is a changes accounting estimate and it should be followed as per India's 8 prospectively, not retrospectively. That's all. I think this is very helpful. This video is very helpful. Listen once and then start preparing. Thank you all. Bye bye.